All right, let's tackle one of the most fundamental puzzles in our globalized world. When money crosses borders, how do we figure out who gets to tax it?
So let's make this real with a scenario you see all the time now. Imagine you're a freelance developer. You're living in Portugal, which sounds amazing, by the way, but you're doing all your work for a tech company based out in California. The payment hits your bank account. So the big question is, when tax time comes around, who gets a slice of that income? Is it Portugal? Because, hey, that's where you live and work. Or is it the US? Because that's where the company paying you is located. Or, and this is the scary one, could it be both? This isn't just a thought experiment. It's a huge deal for millions of people. And the answer is locked inside a core tax concept called source rules.
So let's get right into it. Part 1. Your income has a location. So what exactly are source rules? Well, the first thing you have to wrap your head around is that for tax purposes, every single dollar you earn has a home, a geographic location. And finding that location is what these rules are all about. At its core, the idea is actually pretty straightforward. Source rules are basically the checklist a country uses to figure out if your income was generated inside its borders. It's the official test for pinning down where your money was actually made.
You know, a great way to think about it is like a GPS for your money. Seriously, these rules don't care about your nationality or where your bank is. Their one and only job is to drop a pin on the map right at the exact spot where the economic activity happened that made you that money. And why is that GPS so incredibly important? Well, it's because countries basically have two main claims to tax you. There's residence-based taxation, which is when a country taxes its citizens or residents on their income from anywhere in the world. And then you have source-based taxation, where a country taxes any money made inside its borders, no matter who earned it. Since most countries do a bit of both, the source rules become the critical tiebreaker. All right, part 2. Why do these rules even matter? It's all about protecting the tax base and helping countries cooperate. Now, I know this might sound a little academic, but these rules have absolutely massive real-world consequences. They're the foundation of the entire global tax system. They do two main things. First, we protect a country's tax base. I mean, think about it. Without them, a company could make millions of dollars in one country and then use some clever legal tricks to shift all that profit to a country with zero taxes. Source rules prevent that. They anchor the income to the place where the real economic value was created. And second, they create the rules of the road, so countries can work together, stopping a total free-for-all where everyone is trying to tax the very same dollar. When you boil it all down, that's what this is all about. In the game of international tax, the source rules decide which country gets the first right to tax a piece of income. It's all about who gets the first bite of the apple. Let's move on to part 3, rules for different incomes. So how does this actually work in practice? This is where the theory hits your paycheck, because the specific rule that applies depends entirely on the kind of income we're talking about. Okay, let's run through the big categories. For employment income, your salary, the source is generally where you physically do the work. Makes sense. For a business, the source is where it has what's called a permanent establishment. Now, that's just some tax jargon for a fixed place of business like an office, a store, or a factory. Real estate is the easy one. The income is always sourced to where the property is located. No debate there. And finally, for investments like dividends or interest, the source is typically where the company that's paying you is based. But, of course, there's an exception. For employment income, there's a really important rule that makes short-term business travel way simpler. It's famously known as the 183-day rule, and it comes with a very specific checklist. So, if you want the country you're visiting for work to agree not to tax you, 3 conditions have to be met. Number 1, you are physically present there for less than 183 days during the year. Number 2, your employer is not a resident of that country. And number 3, your salary is not being paid by or charged to a local branch or office of your company in that country. If you can check all 3 of those boxes, you're generally in the clear. Okay, part 4, solving the double tax puzzle. This is all about how treaties make this whole system function. So we've already established that the source country gets the first bite of the apple. But what about your home country, which wants to tax your worldwide income? Well, this sets up the single biggest problem in international tax. And that problem is double taxation. It's exactly what it sounds like. 2 different countries, both legally trying to tax the very same dollar. You can imagine, if there wasn't a fix for this, global business and remote work would pretty much grind to a halt. So the solution comes in the form of tax treaties. These are just agreements between 2 countries on how they're going to handle these issues. They usually provide relief in one of 2 ways. There's the exemption method, where the home country just agrees not to touch the foreign income. But what's much more common is the foreign tax credit method. Let me walk you through how that works. Okay, let's use an example. Say you earn money in country S, the source country. They get first dibs, so they tax you. You pay them $150. Now, back home in country R, your residence country, they calculate that their tax on that same income would have been $250. But here's the magic of the treaty. Country R does not charge you the full $250. Instead, it gives you a credit for the $150 you already paid to country S. So you only owe country R the difference, which is $100. Your total tax paid is $250, and you avoided being taxed twice. Problem solved. So after all of that, let's get to our final section, what you need to know. Let's boil this down to the absolute essentials you should remember. Look, if you remember nothing else, remember these simple anchors. If it's income from your job, the source is where you do the work. If it's income from property, it's where the property is located. If it's income from investments, it's where the payer is based. And for a business, it's where the core activity or office is. These are your go-to rules of thumb.
And that brings us back to our freelance developer in Portugal. So what's the final verdict? Well, since she's physically performing the work in Portugal, her income is sourced there. As a Portuguese resident, she's definitely going to be taxed by Portugal. The big remaining question is what the U.S. will do. And that's where the U.S.-Portugal tax treaty comes in. That's the document that has the final say and, most importantly, provides the mechanism to make sure she doesn't end up paying tax to both countries on the same income. And this all leaves us with one massive final thought. Most of these source rules were designed over a century ago. They were built for a world of factories and physical goods. So the question we all have to ask now is, in an age of global remote work, digital nomads, and value being created in the cloud, how are these ancient rules going to have to change to keep up with the economy of tomorrow?